George, let's start with you. Were the Bank of England right to raise rates yesterday with hard Brexit looking increasingly imminent?
I think they were, and I agree with what Mark Carney said, that you can't simply wait and wait until you find out what the Brexit deal is going to be. It may be that there is even an extension to the Article 50 process, and it might not be for a long time before we know exactly what the outcome is. But I think they were right to do it. I mean, interest rates are only 0.75%. They're still very accommodative, supportive of the economy. And I think one of the most important points is that when you look back over previous decisions when they didn't raise interest rates, for example, back in May this year when it was expected that they might, the economic news had gone down very sharply, and this time round the economic news had remained a lot more positive, and I think therefore it's a reasonable thing that they raised interest rates this time.
George, can you explain why unemployment in the UK is at a 40-year low or thereabouts, but wage growth is the slowest in 6 months? Why is big business so seemingly reluctant to raise pay?
I think one of the problems is that productivity is exceptionally weak in the UK. It's not just the UK, actually, it's around the world, but we're probably in a new regime now where you don't need that strong wage growth because of weak productivity in order that you see unit labour costs, something which was mentioned by the Bank of England quite a lot yesterday, being at a level which is now consistent with the target. In other words, you don't really need very strong wage growth in order to keep inflation at 2% anymore.
George, Manpreet here. Maybe just a question though on Brexit. So I suppose a lot of conversation about that, and I suppose the decision based on the underlying economic data. But how does, I suppose in your view, the central bank handle that? I mean, if it could, of course, take away a huge overhang, or could represent a growth shock.
Well, the way they've been dealing with it recently is to say, well, let's take an average of a number of different outcomes of Brexit. Now, the one thing you can guarantee is that they're not going to be right on this, because they've taken an average of something, of course, which is various different outcomes. But it's one way of dealing with it. Of course, if you're expecting that the Bank of England might raise interest rates again, possibly in 6 months' time, then of course that's going to be just at the time when all of this Brexit news is going to be coming to a head. So February of 2019, we'll have to really wait and see whether we do get a good deal or a bad deal on Brexit. If it is a good deal, remember what Mark Carney said in his speech back at the end of May. He said that we could see a boom in investment and consumption as a result. Admittedly, he also said that if we don't have that's a good deal, we could see exactly the opposite, and the bank might have to do more of the same of what they did in the aftermath of the vote, which was to do more QE. But at the moment, it looks like it's interest rate hikes that we're focused on.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.